In a world filled with information, where do you turn to get straight talk about retirement, investments, and your money? Lock it in to the longest-running financial talk show in Arkansas, and let us help you build the bridge between information and application. Real financial change begins right here, and it starts with you.
It's showtime!
It's the St. Patrick's Day edition of the Get Ready for the Future show, and you know green is our favorite color, but we don't like relying on luck. On today's show, retirement planning tips that will leave you in the green.
This is the Get Ready for the Future show.
And good morning and welcome to another edition of the Get Ready for the Future show. My name is Scott Inman, John Shrewsbury, and Mark Osorio with us today as we get settled in for the St. Patrick's Day edition of the Get Ready for the Future show. As we live stream this morning and record this, it is a stormy Arkansas St. Patrick's Day, and we need a green check. We had this before the show began because as Mark and John sat down, the first noticeable thing for me was, where's the green?
Well, you need an eye check because I have green on.
I do need an eye check.
It's more of a teal, actually.
Well, that's a shade of green.
Okay. Does it? Well, we are talking about 50 shades of green, I guess. So
that's right.
Different shades of green exist.
That's right. And I have that in my shirt a little bit. So do not pinch me, Mark. Whatever you do, you'll get your eye dotted if you pinch me.
6 feet, please.
That's right.
Okay. So if that doesn't qualify, do you have a backup plan? I know you have a backup plan.
Well, I do have a backup plan. So let's see if I can do this here. I have my socks on.
That works. See, I'll check the box on that one.
If that's okay.
Yes.
Green socks, they work.
You've got it. Mark, you don't look like you have green on.
Actually, a little bit on my shirt. If you're gonna count John's teal on his shirt,
I
then
didn't.
you definitely count. Well,
Yeah,
okay.
I counted the socks.
In case you didn't,
there we go.
Got this hat here. If you can tell, Notre Dame green.
Here, let me take care of that for you.
Okay.
We don't cotton the Irish around here. This is Razorback country. So
This is Razorback country.
Our favorite color is green unless it's sports, right?
yeah,
Yes.
that's right.
Then it's red.
That's right.
Hey, so today we're going to have a little fun with the St. Patrick's Day edition of the Get Ready for the Future show. Some retirement planning tips. We've got 4 of them that will leave you in the green, and they all kind of have St. Patrick's Day tie-ins. The first one we're going to jump right in is don't chase the end of the rainbow, right? I mean, that's a pretty good starting point for today. We talk about this a lot, that you can get a little overzealous in your desire to make money as you save and invest, and that can sometimes, John, get you in trouble.
Scott, no time than the most recent time is more evident of this than this whole GameStop thing that came up. You know, everybody got interested in GameStop when they were talking about, shorting that stock and the hedge funds and all of that. You've seen all the publicity in it, and you saw people make a lot of money in that stock in some cases. But what you didn't see, which most people don't talk about, is how much money some folks lost in that. They got in after the bloom was off the rose, so to speak. And I think that is a big danger where somebody feels like they're going to get some sort of insider information or a special deal or whatever the case may be, and they're going to ride that pony all the way to the finish line, and they're going to become rich. It just doesn't happen that way. You may get a story or two over time, and I've seen a few of them in my career, but generally you get rich very slowly, and you get rich through a methodology of saving and investing and building wealth as opposed to striking it rich in either a lottery ticket or a hot stock or some hidden investment that nobody supposedly knows about. Here's the deal. By the time you hear about it, it's probably already over.
Right.
Because you have the publicity machine has to get cranked up in order for, folks in Arkansas, apparently, to hear about it. And then by the time we hear about it, the bloom is off the rose.
And a lot of people think, it's my lucky day, right? This is going to happen. But the thing is, what we know is that you cannot buy financial independence, right? You invest in it. And in the same way that, purchasing a Bible, John, and you can tell me about this, right? Does purchasing a Bible make you a Christian or, a faithful person?
No, you have to. It is the practice of your faith that actually does that. Just having a Bible just means you got a Bible. But here's the key. I mean, an empty hotel room has a Bible, right? You know,
Exactly.
the Gideons put Bibles in hotel rooms all the time. Doesn't make that room holy. It just has a Bible in it. And so when you think about investing, it's not just the act of investing, but it's the disciplines that you employ in it, the strategies that you employ in that, and the advice that you get along the way. And again, our mantra to people is don't chase that hot dot. Don't listen to, you know, the hype that is out there in anything. And Scott, you know, there are folks that sit around and watch CNBC or Fox Business or whatever, and they just hang on every word of those analysts. And those guys have no point of reference on your financial future.
Right.
They know nothing about your personal situation. As a matter of fact, they may even have a vested interest in talking up a stock. You never do know. They try to disclose sometimes whether they have a position in a particular stock or not. But generally, those folks have no knowledge of you or your situation and whether what they're talking about is even appropriate for you or not.
We explain it this way to our clients in meeting rooms oftentimes. They ride up to in the Little Rock office, there's an elevator that takes them to the 6th floor.
Right.
And if you are invested in an individual equity, one singular stock, whether it's GameStop or even whether it's Apple or Microsoft, which has a great history of production and performance, you're held up in that elevator by one cable. And if that cable snaps, the elevator goes crashing down, right?
Dangerous bet, yeah.
Yes. So if you diversify in things like mutual funds and ETFs that have multiple, maybe upwards of 30 to 40 individual equities, then you're held up by 30 or 40 cables in that elevator. And if 1 or 2 or 3 snap, you still arrive at your destination. And that's the analogy I think you need to have as a takeaway here. It's not that buying individual stocks is wrong, but it shouldn't be done with money you're counting on for retirement.
Scott, I think you have to think about why people chase the end of the rainbow. They are really not interested in doing the tough work, the hard work of systematically investing, having the iron constitution to stay with something, especially when the market is going down. How many people have we run across over the years that said, I stopped investing in my 401k when something bad happened in the market, you know, and that's obviously just the wrong thing to do, Mark, because they're not taking advantage of the opportunities that a down market gives them to buy.
Yes, and something that we talk to people about all the time, you know, when we talk about the risk and reward relationship, right? And the thing is that whenever we have a down market, right, and like 2007, 2008, 2009, the people that held on, right, John, were the people that actually were able to get through, because what we know is that the perceived loss of value is not an actual realized loss in your pocket, meaning that it's only a loss when you actually sell.
Right. It is a temporary, if you will, decrease in value. Scott, I think about the guy that's at the casino and he's got some money and he just goes all in.
Yeah.
You know, do you really want to go all in with your retirement dollars? Mm-hmm. I think that's a huge risk for a lot of people. But there are some people that really think that way and think that that's the way to do it. They, you know, buy into the fantasy stories, if you will, of get rich quick, and they end up being relieved of their money because it doesn't work out for them for whatever reason. The fundamentals just didn't happen. I don't think that's a way that you want to spend your life. I don't think that's the way you want to spend your retirement money. I think you've got to think about this from a standpoint of what makes logical sense for my serious money. Now, if you want to take a little bit of money and you know, throw it at something, then I don't have a big problem with that, because if it's disposable income, you don't need it necessarily. But if it's money that you're going to need at some point in time, you don't want to chase that rainbow.
Great imagery there of going all in, because that happens out of desperation.
Yes.
Even the professional gamblers don't do that unless they have to, right?
Yes.
It is usually done out of desperation. So what's the plan? Feeling secure about your future starts with how you see your future. You can reshape your idea of planning with What's the Plan? A manifesto for your life, your worth, and what happens next. Visit getreadyforthefuture.com/plan, and we'll have more on the St. Patrick's Day edition of the show after this.
Hey, it's John and Janet from Gen Wealth Financial Advisors, and we are so excited and honored to be named Arkansas Money and Politics Best of the Best in 2020 in 2 categories. One as Best Financial Advisors, but secondly, Best Women-Owned Business.
Thank you so much for your vote of confidence in us. We know it's the Gen Wealth Financial Advisors name that showed up, but we also know that we couldn't have done it without you. So thank you so much for your support and for your vote of appreciation for Gen Wealth.
There's always been power in standing up for what you believe in, challenging the status quo, and never accepting the ordinary. What about the rest of your life? Will you settle? Or will your retirement be more? More fun, more family than finances, more than just investments. Connect with us at Gen Wealth and harness the power of more.
Simpler, more personal approach to retirement continues with the Get Ready for the Future show.
For retirement planning tips that will leave you in the green. That's the subject of today's St. Patrick's Day edition of the Get Ready for the Future show. My name is Scott Inman. John Shrewsbury and Mark Osorio with us today on the show. I mentioned right before the end of our first segment how to get your What's the Plan, a manifesto for your life, your worth, and what happens next. Visit getreadyforthefuture.com/plan. I said that, but I ran out of time to tell you there's another way. You can also text the word PLAN, P-L-A-N, to 501-381-5228. Again, it's 501-381-5228. It's a free brochure that you can kind of get some concepts about building your financial future. And we're giving you 4 tips today. Our first one in the last segment was don't chase the end of the rainbow. Don't chase high returns. And I might also include in there, we ran out of time before I could say this, but what's another way that people kind of measure success? It's the benchmarks, right? They want to outperform. They're so concentrated, John, on outperforming, and usually that benchmark is the S&P 500. It's a comparison that I think even maybe not on the level of GameStop and individual equities can still be problematic in how you see your future.
Yeah, I don't get that to any great degree, Scott. Obviously, that's something that is out there and people do it, but why does it matter? Is it just that you want to keep up with the market? I think the key question is, how much risk am I taking and how much return do I need?
Right.
Because you can make all kinds of returns. You can get a great return if you're willing to take on the risk. You can outperform the S&P 500 if you're willing to take on the risk. The problem is, when things are not going well, how is that going to make you behave? And oftentimes we see people want to cut and run when things are not going well. And that's why you would moderate your rate of return and moderate your risk as well. I believe that you want to take just as much risk as you need to accomplish your goal, and you want to get just enough return that actually gets you where you want to go. But you don't want to take so much risk that it would cause you to behave differently when times are bad. That's when most people make mistakes in investing.
So here's retirement tip number 2 on today's show. Leave the legends behind. The legends. We're gonna have to really sort through this and dig deep to make the connection here. But St. Patrick's Day, the day we celebrate today, is largely based in legend. And I didn't even know some of these things until Abby, our crack researcher, gave it to us.
Me either.
St. Patrick was not even Irish. right?
Really?
I kind of knew that. I remember that. I feel like I should have known that anyway. But I'm pretty sure he was English, right?
All I know is that he's Ireland's patron saint, right?
That's right.
So you would think he'd be Irish.
They loved him, but he wasn't from there. And another myth that's been debunked, he banished snakes from the Emerald Isle. I feel like there's some story about that. And
snake charmer.
Yeah, and that green has historically been associated with St. Patrick's Day. Huh.
Not so.
How about that? He was Roman, I'm being told. I thought he was English, but Roman. Okay, yeah, that makes sense.
Casey, the researcher.
Casey, did you Google that, Casey, or did you already know that? Tell me the truth. That's what I thought.
Yeah.
Okay, I don't know if you can hear Casey.
You can't hear Casey, but you can. We'll interpret for him.
All right,
that'll be fun.
So, what are the legends when it comes to investing that you should leave the legends behind? And I think this topic of discussion in this segment is all really summed up by this, John. People like to try to time the market.
Yeah, and there's the whole sell in May and go away thing that Ryan Dietrich, speaking of a Irish name, Dietrich probably Irish, wouldn't you think?
He's wearing green
I'd
today.
say so.
He's probably wearing green today. But Ryan Dietrich has debunked the sell in May and go away thing on several occasions on this show. It really does not necessarily hold true. The concept for this old investor adage is that returns in the stock market will likely be worse May through October because supposedly the traders go on vacation May through October. Now, first of all, I don't know anybody that takes that long of a vacation, but there is a little bit of a depressed activity, if you will, on Wall Street during that time because obviously they do enjoy their summers. But you cannot hang your hat on that. As a matter of fact, if you think about this past year, from May until October was a great time to be in the market.
You definitely didn't want to miss out then.
Yeah, and if you'd sold in May and gone away, you would have probably not participated in the big upturn after we had the big downturn February and March of 2020.
Yeah, and the thing is, historical data is just that, historical, and it can be used in multiple ways. You can do your statistics yoga on it, and so you can see from 1950 to 2013, statistics that would seem to back up the whole sell in May and go away. But then there's also a different set of data that shows quite the opposite, right? When looking at December 1979 through March 2020, where from May to October there was actually fantastic returns. And if you look at the data and from the point of view that if you invested that $10,000 into the S&P 500 during that time period, what we really want to see and what we really want to show is that what you don't want to miss and what you would miss if you did the whole sell in May and go away is you might miss out on some of the best moments in the market.
Yeah.
And Scott, tell us kind of a little bit about what that means for our portfolio.
Well, so it is about time in the market, not timing the market. And we've got a great graph for those of you watching on our streaming, and this is going to be the second graph is what we're going to jump to because that's what Mark is referencing. The potential growth of $10,000, a $10,000 investment in the S&P 500 index from December 31st, 1979 through March 31st of 2020. So this is pretty recent data. If you were invested every day, so again, our concept here, time in the market, not timing the market. If you were invested every day of that period, your investment of $10,000 would have grown over the 40-plus years to $697,421. Great. But if you miss just the 5 best days of the market over that same period, and John, that's a 40-year time frame. We're only talking about 5 best days of the market.
Yeah, if you were snoozing, and missed it.
Rather than 697,421, it's 432,411, a difference of more than $200,000.
That's significant.
Yeah, there's a huge amount of missed growth. If you go out and miss the 50 best days, you miss $648,000 in growth.
Yeah.
An incredible number. Now, Scott, let's be sure to make this disclosure.
Yep.
The S&P 500 is an unmanaged index, and there is no way to directly invest in the S&P 500 itself. Now, you can get some funds that mimic the S&P 500 and that type of thing, but this is for illustrative purposes only. And our point here is that you need to stay fully invested. You don't need to try to time the market because every time somebody has tried to time the market, oftentimes it's, not been to their advantage. You think about just in recent past, how many people thought with the change in the presidential administration that we were going to have a big downturn in the market right after the election? Mm-hmm. We had that conversation over and over and over again. Mm-hmm. And what you will find here at GenWealth is that we are not interested in timing the market. We are interested in looking at facts and statistics and data and research. That's why we partner with an excellent research team at LPL Financial to help us to sort through all of that. I had this conversation with a client the other day. The client had heard that we were going to have a cataclysmic meltdown of the market. Well, what do the facts say? The facts don't bear that out. The facts look at the economy and go, okay, things are actually recovering, doing well. We're seeing some growth in earnings. We're seeing some growth in the actual prices on the S&P 500. Are there things to worry about? Yes, there are. But here's the secret. There are always things to worry about. There are always reasons for you to not invest. Scott, I can remember when I first began in this business in the little small office that I had back in El Dorado back in the 80s. I had a chart in the office that basically said there are always reasons not to invest. And this chart charted the market over time, and then every year it was the crisis of the year. Whatever was going on, it flagged what that crisis is. And what you find when you have that kind of perspective, you step back and look at it and you see that, okay, there's always been some reason, some excuse not to put your money in the market, but that excuse paled against the return of the market.
You mentioned the election. I actually had a couple of conversations with folks who were not clients of GenWealth that talked about that they were all in cash riding up to the election because of that same reason, some of those same reasons you talked about. They were expecting a very big downturn right after the November election, and that, of course, did not happen. And I think it's worth pointing out, too, here, guys, that you can't time the market because the market doesn't always behave logically in the short term, right? It does behave fundamentally over the long term, but it can have some emotional spasms that nobody, not even people who like us who watch it every day, can possibly predict that they're coming.
I'm talking about the crisis of the year, right? I mean, you look at the news and it's the soup du jour, right? It's the crisis of the day. So yeah, we can be very discouraged just about any day when we look at the news because it's always bad. It's always something that's going on wrong. And it's not until later, to our point in the last segment, that we find out about all the gains that certain people took place in, and we don't find out about those until after it's happened.
Scott, I think about separating the wheat from the chaff, and I think that's what good research does. There's always noise out there. And what you have to be able to do is you have to be able to sort through that noise and find the things that matter. Find the things that actually are going to drive the market. Find the things that are actually going to affect stock prices. Find the things that you can hang your hat on. Here at GenWealth, we believe at the end of the day, earnings really do drive the market. Now, there's a lot of stuff that might affect it in the meantime, but over time, earnings drive the market. And if earnings are good, the market is going to go up. If earnings are bad, then the market's going to go down. And that is really what it boils down to. It is all about the bottom line in corporate America and on Wall Street, and earnings really are indicative of the bottom line of most companies. If you're paying attention to earnings, then you can not pay attention to a lot of other things, and you can probably come out okay.
Now, we are talking about investing and having a growth mindset and accumulating, but we are giving retirement planning tips today. I do think it's worth pointing out here when you get inside that retirement red zone that taking some of the risk off because of that short-term volatility that we can expect to have in the market is a good idea, and we're going to play that out a little bit later on in the show. So it does need, that investment strategy does need a different look when you're inside of 10 years away from retirement. Okay, so we're through 2 retirement planning tips that will leave you in the green on this St. Patrick's Day. We've got 2 more to come, so stay with us. The Get Ready for the Future show continues right after this.
At Gen Wealth, one of our standards is that we value good communication. One of my favorite quotes about good communication is from George Bernard Shaw. He said, "The single biggest problem in communication is the illusion that it has taken place. If you ever doubt that, come to my house, listen to my 16-year-old son and my 13-year-old daughter having a conversation and see what happens, because they will walk away with completely different understandings of the conversation that has occurred." It happens every time. It's okay, they're still learning communication. But here at Gen Wealth, we believe that that's something you need to experience every time you walk in our door, that you need to feel understood, that you need to feel listened to. So you'll see a change in how we're even communicating. If you're talking about something that's very serious, very personal, you'll even hear a change in our tone of voice, because that's just how good communication is supposed to be. But it also means that we can feed back to you what you've shared with us, just so you know that we're listening. We value good communication.
Education-driven, strategy-based, team-delivered. That's how we roll on the Get Ready for the Future show, and we're back for more.
For retirement planning tips that will leave you in the green, it's the St. Patrick's Day edition of the Get Ready for the Future show. I'm Scott Inman, along with John Shrewsbury and Mark Osorio, who works with me in the Little Rock office. Gen Wealth Advisors are near you. We have a Little Rock office, Conway, Bryant, even though right now it's a little bit in flux with Bryant being closed. We do have Bryant Advisors, but we have mentioned before on the show, John, that the Bryant office is undergoing some remodeling because of some damage received during the most recent snowstorm back in February. But we hope that is progressing, but we still are working. Those Bryant advisors are still ready to meet.
Yeah, our marketing department across the parking lot from our office, if you're familiar with the Bryant complex that we're in, our marketing department has taken on some advisors. I think Troy and Ginger are generally in the Bryant office. Janet and I are, as I said yesterday to someone on the phone, we are corporately homeless these days. And so we're kind of vagabonds, and we work from home sometimes. Sometimes we work from the marketing department. Sometimes we work from the West Little Rock office, intrude on Scott's territory up there. But we're active and we're rolling. We haven't missed a beat. A little leak of water in the office isn't going to stop the Gen Wealth train. We're still going, and we are hopeful that all of this, once insurance claims are settled and things of that nature, we will have basically a brand new Bryant office for our clients to enjoy here in Bryant.
Well, isn't technology great that we can still operate?
Yes.
Even when we're homeless, as you said. But I didn't mention the other offices. So I said Conway, Little Rock, and Bryant. We also have a Hot Springs office and an El Dorado office. So if you're hearing us or watching us today, there's a Gen Wealth advisor and a Gen Wealth office near you. And if you'd like to sit down with an advisor and talk about your retirement planning or your investments, we are always there to do that. And that first appointment is always complimentary. You can call 501-653-7355. Again, it's 501-653-7355. And Anna Olive is our client introductory specialist. She'll get back with you, ask you a few questions so that she can prepare the advisors and appoint an advisor to you that can best work with you. And again, I can't point out enough, that first appointment is complimentary, so there's no risk. We've talked a lot about risk in this show. There's no downside risk to coming in and just having a discussion to see if we can do something for you and help you in your retirement planning. So we're talking about retirement planning tips today. Our first one earlier in the show, don't chase the end of the rainbow. Don't chase performance. Don't chase the hot stock tip of the day with your retirement money. If you want to do that with some money you're not counting on for retirement, great. But not with money you're counting on a specific outcome, which is a successful retirement. Number 2 is leave the legends behind. We talked about the legends of St. Patrick's Day and the legends that exist out there about timing the market and how that's a fool's errand as well. If you miss just the 5 best days over a 40-year period historically, it could make a big dent in how much you're able to accumulate. Number 3 today is protect your pot of gold. Now, there are lots of avenues that we can take here, guys, about protection. Protection can exist in many forms, and it can exist at many times along your journey towards retirement, right? I mean, it doesn't have to be at retirement when you need protection. The first place we're stopping off here, Mark, is in your pre-retirement years, maybe even in your 20s and 30s, something that you can think about that people don't think about protecting their retirement with, but it's life insurance.
Yes, and this is a conversation that I have with multiple times a week with clients that come to see us, right? And sometimes, they're working through the steps. They're, trying to get an emergency fund taken care of. They're paying off debt. So it's they're on their mind. The next thing, we want to invest, get some things going in that direction. But kind of like you said, there's you have to keep risk in mind, because especially with younger clients, right? There's just a huge risk to them losing out on their future because of something. If one of us or if one of the partners don't come home. So when we look at that, we talk a lot about in this segment protecting your pot of gold. Right, and so life insurance is that tool that we use, and it has a lot of uses, but also a lot of planning points.
Mark, I think that, a lot of people these days are kind of cavalier about this issue of life insurance, and there's nothing going to happen to me and that type of thing. I don't think that I can imagine a situation that is more dreadful than a young family having a father or a mother, one of the two, pass away and leaving a financial void for the survivors. If you think about, most families are dependent on two incomes these days, and if you take one of those incomes away, it becomes a real struggle. And from a financial standpoint, I know that spending money on life insurance seems like it is, just a tossing away of dollars. But what you're really doing is you're really ensuring the well-being of your family should you not come home. And life insurance is a conversation that we have with young clients and middle-aged clients. Now, older clients may not have as big a need for life insurance because as time goes on, they have built that wealth, and that wealth will actually sustain the survivors of a family if something happens to somebody during their retirement years or right before their retirement years. And you may not have as huge a need as you would have if you're young, have a house mortgage, kids needing to go to school, all the things that are necessary to raise a family. If that's dependent upon your income, you need to think about a way to protect that income, and that income is really what creates that pot of gold for the future.
Right.
You're not only depriving your family of some well-being in the current time, but you're also impacting what that family's wealth is going to be in the future.
You're protecting the pot of gold before it's a pot of gold.
That's right.
Those
Exactly.
future contributions don't happen. Those future contributions to retirement accounts, those employer matches, if somebody doesn't come home, those things don't happen. And as you mentioned, John, there may not be as much of a need of life insurance for retirees. They, in all ways we would plan, they would have the assets there to self-insure, right? The income for the income perspective. But what has to happen is a little bit of a change in law with the Secure Act, that if legacy is something you're trying to protect as a retiree, there may be a need for life insurance there.
Man, I'm just on the bandwagon about this Secure Act. I call it the Insecure Act because it created insecurity about, a lot of things that are going on from the retirement standpoint. So in the past, what you've been able to do is you've been able to use your IRA dollars, grow them, hopefully maintain some wealth in your IRA accounts over the years, and then pass that along maybe to your kids. And then your kids had the option of stretching out the withdrawals of those IRA dollars over their lifetime. And so you had the ability for compound interest to kick in and maybe make up for some of the required distributions that were being done over that lifetime. And it had this effect of being a generation to generation perpetuation of wealth. Well, the IRS came in a couple of years ago. Actually, Congress came in a couple of years ago and said, no, we're not going to do that anymore. We're not going to allow the lifetime stretching of an IRA account to a non-spouse beneficiary. Now, spouses can inherit each other's IRA, and there's no problem with that. But when it goes to the kids now have to take that money out over a 10-year period of time. Now, consequently, what generally happens is that a kid is going to inherit a parent's IRA probably at that child's peak earning years. And so the overall tax impact of that is pretty tremendous. And it does have a way of diminishing that wealth over that 10-year period of time. So what's the answer? Spend your IRA money, but buy life insurance that can be passed on to your children. That life insurance is passed on tax-free as a death benefit at your passing. It allows you to spend the IRA money, but still give a non-tax encumbered benefit to your children.
And the other thing about protection is when you do reach retirement, if you have the assets that life insurance is not a big need, what about a long-term care need? We've talked a lot about healthcare costs in previous shows here recently that they are definitely something you have to plan for. A healthy 65-year-old couple retiring last year in 2020 projected to be have $387,000 plus in today's dollars in healthcare costs. But that's healthcare out of pocket, right? That does not include long-term care coverage, which Medicare, by the way, a lot of people don't realize this, does not cover long-term care needs. So that has the potential of really, we build retirement income plans every day for our clients. That is the elephant in the room that we have to address, because that has the potential to blow up a retirement income plan if one or both members of a married couple need long-term care in the future during their retirement, and the chances are, statistically, that 7 in 10 will. So how do you address it?
So I know that in the office, one of the things that we talk about is long-term care insurance, right? And there's typically a couple of different routes that you can go about it with traditional long-term care insurance, as well as the hybrid policies. What exactly can you tell us about the policies?
Well, if you think about the hybrid policies, they are a combination of life insurance and long-term care. And that type of policy actually does have almost a dual benefit, where you could use some of the face value of that policy for long-term care coverage. And if you pass away, then the remaining part of that face amount that you did not use for long-term care can actually be paid to your family as a tax-free death benefit. Now, traditional long-term care insurance is a little more restrictive, a little bit harder to deal with, because it is what's called an indemnification policy, meaning that you would have an event that you expend money through a certified caregiver, like a nursing home or a home health care operation or something like that. You pay for that coverage or for that service, and then you file a claim against your long-term care to recover that benefit. And there's a lot of restrictions to how those things pay out, but the hybrid policies, those dollars can be used for anything. And so we often recommend people look at those hybrid policies simply because of their flexibility and things of that nature. But there are ways to protect your wealth with long-term care. And look, you could easily, I was talking with a client the other day that has a significant amount of wealth, and then we were talking about whether a long-term care policy was even necessary for him or not. And what it really boiled down to was whether that long-term care policy was going to kick in and preserve that wealth for the next generation.
Feeling secure about your future starts with how you see your future. Reshape your idea of planning with What's the Plan? A manifesto for your life, your worth, and what happens next. Here's how to get it. Go to getreadyforthefuture.com/plan, or text the word PLAN to 501-381-5228. The Get Ready for the Future show continues. Our final segment coming up right after this.
The beauty of a potter's work is that each item is unique. No piece is the same. That's what makes it art. At Gen Wealth, we believe your financial plan should be unique to you. Through our process, your money is carefully shaped around your goals and dreams. Your future, artfully crafted. Call us today or visit our website and connect with us. Gen Wealth Financial Advisors.
I don't think it's any coincidence that the Bible says, "Fear not," 365 times, one for every day of the year. At Gen Wealth, one of our standards is that we do not fear. We don't fear market downturns because we know that they're going to happen. We just simply plan for those things to happen and work around them. It's one of the things that we believe very earnestly, that you should never fear what you don't understand. You simply find a way to understand it and find a way to use it to your advantage. It's one of the GenWealth standards.
You ain't heard nothing yet. Buckle up, because we're back with the Get Ready for the Future show.
Our show today on this St. Patrick's Day, as we record on March 17th, 4 retirement planning tips that will leave you in the green. And we've gone through our first 3. Don't chase the end of the rainbow. There's not always a pot of gold out there. Looking for high returns in individual equities, or trying to outperform benchmarks like the S&P 500, not the game plan for a successful retirement. If you want to invest in individual equities, great. Just don't use the money you're counting on in retirement. Number 2 is leave the legends behind. There are legends out there about St. Patrick that turned out to be debunked and are mythical, and there are mythical things that people believe about the market, like sell in May and go away. It all kind of revolves around trying to time the market, and we pointed out that that's a fool's errand as well. Last segment, we talked about protecting your pot of gold, either before you even have the pot of gold in your pre-retirement years with term life insurance, to make sure that if one of the two of you, if you're a married couple, don't come home, that the income is replaced and the future contributions to retirement can still be there. Also, long-term care, another way to protect. Long-term care insurance, you need to sit down with an advisor to talk about the potential need for that. Can you self-insure, or can you leverage an insurance company to provide for long-term care needs in the future? Our final one is make your own luck. You know, we mentioned at the beginning of the show, we don't really want to rely on luck when it comes to building a retirement plan. We want to build it on math and science, goals, outcomes. And John, the outcome, we say it all the time, is income.
Scott, what is luck? What do you do when you count on luck? You hope, right? I just hope everything works out. I hope I get lucky. I hope I, win that scratch-off ticket, or whatever the case may be. Hope is not a strategy. What is a strategy? Well, first of all, I think it's very important to know that no one else is really going to be as interested in your financial independence as you are. And you may say, well, John, I don't know anything about how to build financial independence. I just know how to do my job, and I know how to raise my kids and all of that. That's okay. You can assemble a team around you that can help you toward that financial independence. And so that's really what we do here at GenWealth, is that I think that having a team of professionals working on your behalf, working in your best interest, is really the key toward building financial independence. Mark, a lot of people think, well, I'll just go out here and read some stuff on the internet and find my path on this myself, and that's not necessarily the right thing to do. There's a lot of information out there, but there's a big difference between information and knowledge.
Certainly. And yeah, you can read all about all these topics, but it's another thing once you get there and actually going through all of those things. Whenever I step out of the door each day, and let's say if I'm going on a trip, right? If I'm wanting to get from here to Colorado or Montana, wherever it may be, right? If I just start walking randomly in a direction, all it is hope that I will end up where I'm trying to get to. Right. So I depend on GPS. I depend on directions, as you said, on other things that have the capability of helping me arrive where I want to be. And that's exactly what we want to be here, as a resource to make sure that you're not just embarking on this on your own with just the hope that you're going to end up where you want to be.
Scott, at GenWealth, we've got the Ready to Retire process, and this is a template, I like to call it, because it is a framework in which we work to get you ready to retire and keep you retired throughout the rest of your life. But there are some elements to the Ready to Retire process that we are incredibly gifted at customizing for you to help you get to that type of retirement that you're looking for. You know, Scott, the first thing that we're going to do is we're going to sit down and really talk about where it is you want to go. Mark referenced going to Colorado, going to Montana. Well, that's great if you like, you know, cool weather or cold weather or whatever the case may be. I'm probably going the other direction. I'm probably going south. I'm probably going where it's sunny and warm, and I just like to sweat as opposed to freeze to death. And so it's much easier for me to do that. And Mark loves, you know, that type of thing in the northern part of the country. Fabulous. We are each different individuals, but we can flex that plan to basically meet the needs of whatever you have coming in looking to retire.
Nowhere do you want to not rely on luck more than when you step into retirement and move in from an accumulation phase to a decumulation or distribution phase of your life. You know, I think a lot of people look at retirement as the finish line. I accumulate, and I've got my pot of gold, to keep the St. Patrick's Day thing going, at the end of the rainbow. But that's not the end of the rainbow. How are you going to spend it in retirement? It is more than just investments. And we referenced this earlier in the show about the difference between a growth mindset and then an investment strategy to distribute income. And that's where the retirement planning, the investment strategy part of the Ready to Retire process, John, comes into play. And it comes into play in the sense that we have to really designate specific buckets of money for different times of retirement for it to be spent.
Look, it is very logical to me that you want to have regular, predictable income coming in to take care of those regular, predictable, dependable bills that are going to be coming in. Just because you retire doesn't mean that all the expenses stop. You still will have maybe a house mortgage. You will still have credit card payments if you have credit card debt. You will still have food, clothing, transportation costs, health insurance, taxes. All of those things are necessities of life. I believe that you can account for what that's going to cost you on an annual basis, and then match that up with guaranteed income from things like Social Security, a pension if you have them, and some other type of guaranteed income source that would meet those regular needs. So that if everything really went haywire in your life, you know that money is going to come in to meet those regular monthly expenses that you have. Once you kind of get that foundation built in your house of financial security, if you will, then you want to go up a level and then think about the things that you really want to spend money on. Those are the things that you need to spend money on. You want to focus on now, once you've got that established, what you want to spend money on. That's things like lifestyle things that you want to go, Mark, if you want to go to Montana, great. You can take that Montana vacation because you've accounted for that expense above what your basic level expenses are in retirement. And so I think that is the process that everyone should logically follow when they are looking at building their retirement income plan. Another thing that you've got to do there is you've got to keep pace with inflation.
Yes.
Inflation is one of those things that we're going to have to deal with more and more as time goes on, because we are probably turning the corner into a more inflationary environment, and that's going to become a bigger topic in the retirement conversations that we have with people on a daily basis.
And I love that you mentioned, that difference between the incomes, right? As far as the amount that you need versus what you are going to have guaranteed. And correct me if I'm wrong, but that would be our gap analysis, right? Which is first step in our Ready to Retire process. And earlier we were talking about how you can't, just buy financial independence. You invest in it, and that goes a lot to talking towards the fact that for a long time, financial advisors have been focused on investments, right? And we know here that there's not a perfect investment, right? So we go through our bucketing strategy, like Scott was talking about, to provide that income plan that then gives the individual that we're building a plan for that ability to do those extra things in retirement that they really enjoy. and which is all again in our retirement process. John, can you tell us a little bit more about that?
Well, the Ready to Retire process is available really to anybody, Scott. All you have to do is pick up the phone and give us a call, and we would sit down and create that process for you. As I said earlier, it is a template by which we run toward this retirement goal, but it's very customized to your particular situation. And I think it's very easy for people to take advantage of that.
Yeah, and you don't have to be ready to retire, not imminently, right? It can be 10, 15 years down the road, but a plan in place gives you a target. You can call 501-653-7355 and set up a first appointment to begin walking through the Ready to Retire process. You heard the final bell. That means that it's time for our final thoughts. Mark, you're in the chair that always goes first.
Well, kind of like I said, you can go at retirement just with the hope, right? And maybe you woke up today feeling lucky, or maybe you woke up today just realizing that, hey, you've got to do something about your situation, because you want to make your own luck, not just arrive one day and wake up and realize that what you got in front of you is all you got. So we want to give you options. Contacting us is a great way to get that process started.
Scott, I think that you feeling secure about your future really starts with how you see your future. I think that is huge. And we've got 10 ways to kind of shift your focus, if you will, on your future and the prospects of planning and what have you. It's that download that Scott has talked about throughout the show. What's the plan? A manifesto for your life, your worth, and what happens next. You can get your free copy at getreadyforthefuture.com/plan or text plan at 501-381-5228.
Well, John, you mentioned earlier in the show that hope is not a plan, and if you're relying on luck or just a collection of investments to get you through retirement, I think that is akin to the luck of the Irish. You're just hoping that everything's going to work out. Hope is not a plan. So my final thought is a plan changes your outlook on retirement, because it at Gen Wealth is on paper, on purpose. It is in a 3-ring binder. It has a Social Security analysis and strategy of when to claim Social Security. And more importantly, it has a defined monthly income plan with raises over the course of possibly a 30-year retirement, and a tracking system to see what types of rates of return you need for the outcome, which is income. So I would suggest on paper, on purpose is the route to go. Call us at 501-653-7355 for more on the Ready to Retire process. We'll talk to you again next week.
The Gen Wealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 501-653-7355. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Gen Wealth Financial Advisors is an Arkansas-registered investment advisor with securities offered through LPL Financial, member FINRA SIPC.